Good afternoon, everyone. My name is Tracy Nyer, and I'm with the Virginia Small Business Development Center Network. For those of you who are not familiar with our organization, the Virginia SBDC is a partnership program between the U.S. Small Business Administration, George Mason University, and local host institutions throughout Virginia. With 27 locations across the Commonwealth, we provide training and technical assistance to small businesses in their local communities. Our one-on-one consulting services are available at no charge. Today's webinar, Financial Management for Childcare Businesses, is one of our educational offerings. We are recording today's presentation and it'll be posted on our website, virginiasbdc.org. Due to the large number of participants, everyone's microphone is muted, but if you have questions during the presentation, you can go ahead and type those into the Q&A window. We have also enabled the live transcript function, which you can show or hide via your meeting controls in Zoom. So please help me in welcoming our presenters for today's presentation, Lauren Small and Virginia Marsh.
Thank you, Tracy. It's a pleasure to be here. I'm Lauren. I'm the owner of Early Education Business Consultants. I'm joined with by my colleague, Virginia Marsh, who is our Director of Operations. We are also business analysts with the Hampton Roads Small Business Development Center. And so we're here today to do the third workshop in this four-part series for early childhood providers. The last two sessions really centered around human resource management and really talking about the workforce crisis. Today, we'll be talking about financial management, which is, again, a really important piece of this workforce crisis. But before I get into that, one of the things that our company does is we have a partnership with the Virginia Small Business Development Center to teach and run a business management program. So if you are interested in something more in depth than what we've been doing in these workshops, the business management program is a pilot program in partnership with the Small Business Development Center. And we actually have a fall cohort running right now, and we have another one that will be running in the spring. And there are small cohorts from 10 to 12 childcare programs. Have to be located in Virginia. They can be both licensed and voluntarily registered or religious exempt nonprofits. Really, the focus is on independent operators, and the program is designed to offer a series of 8 in-depth workshops that look at each piece of the business model with the goal of filling in the blanks in your business knowledge and confidence. It helps to reduce employee turnover, increase revenue and enrollment, and ultimately is to just designed to support you all in offering high quality early childhood. The program is at no cost. It's grant funded, but it does require a commitment of time. And the other benefit of the program is not only is there the course, but there's individual consulting with our team and also linking up with the local Small Business Development Center in your community. So if you would like to learn more about this, you can apply for the program and we'll contact you, and it'll put your information onto our spreadsheet. Or you can contact us just individually to ask questions, and we'll be providing our contact info at the on the PowerPoint. I'll be managing the chat box, so feel free to ask questions. Virginia will actually be presenting the topic today around financial management. So I'm going to turn it over to you now, Virginia. Thank you.
Great. Hi, everybody. Thanks for joining us today. I'm just going to take a moment to change over my screen that I was sharing, and then we'll go ahead and get started. Lauren, can you see my screen, the presentation?
Not yet.
Oh, okay. Let's see here. I'm hoping that did the trick.
There we go. Yes, we can see it
Okay,
now.
perfect. All right. So as Lauren was sharing, our company has been focused on the early childhood industry solely for 8 years now, but collectively we have over 30 years of experience with the industry. Lauren has deep roots with the SBDC, the Chamber of Commerce, and instructional teaching. I have 10 years of experience in a religious exempt center where I was the director for 6 years and have a business background. She and I are both what do you call it, analysts for the SBDC. Sorry, that word just slipped my mind there. And we primarily focus on business management training programs. And there's about 10 years ago, Lauren started the early education business program that she shared that link with you a little bit at the beginning of this program. And I was fortunate to take that program with her back in 2013. And then just she and I had just built some rapport and shared how we were working together. And then it branched into us being able to full-time work with each other on these training and different programs to help providers here locally. COVID gave us the ability to kind of spread our contact beyond Hampton Roads. So we've been able to work with providers nationally, as well as with the SBDC in the state of Virginia. So excited about that. My primary, I focus a lot on technology implementation. I have kind of made it my goal to understand and work with the different childcare management systems that our industry offers, and to be able to help providers not only implement, but to select the best programs for them. And then I also, you'll see today, I just have a thing for spreadsheets and financial management. And so that seems to be where I focus a lot of my time and attention on. And in the last year or so, we have taken on the Hampton Roads Shared Service Alliance Hub and provide back office business support for programs here in Hampton Roads, and really helping them to shore up their business practices, give them that extra hand that they need so that they can spend more time with the children and the teachers and doing that pedagogical leadership in the classroom. So like Lauren said, we're going to focus primarily today on financial forecasting. And I'll tell you the reason. So our agenda today, we really want to talk about why this is important right now. We've seen the need for financial forecasting became a primary focus when COVID started, and centers were concerned about how they were going to make it through short time, long-term closures, sometimes the quarantine periods, and even preparing for, did they need a PPP? Did they need to apply for the EIDLs? How were they going to use it? We found that understanding their financial model became more and more important, and many providers weren't prepared to be able to answer those questions. And it continues to be an important function of business as we're moving forward. We're going to talk a little bit more about the I triangle today. We're going to talk about cash management, understanding cash flow, identifying gaps, and then being able to run different scenarios for your center. And we will share a couple tools with you that hopefully you'll be able to utilize at your center as well. So let's talk about why cash flow and financial management, financial forecasting is important right now. And you may, if you were with us into one of our previous sessions, you'll remember this slide, but we really talked about with our human resource crisis, our staffing crisis right now, one of the major things our industry needs to do is look at how we're paying our staff and the financial benefits that we're able to offer. And we talked about this. I know it's scary, but that our wages to be our biggest competition for staff right now is food service. And we know there are McDonald's, Chick-fil-A, other restaurants are offering a minimum of $15 an hour to bring on new staff, and with hiring bonuses. So to be able to compete with that industry, we need to start raising our wages $2 to $4 an hour, if not more. And this is increasing our prices. We're having to look at what we need to do with our tuition rates, our payroll rates, to be able to compete for those staff members. We're suggesting utilizing this stabilization grants that have just come out as a means for increasing wages and being able to pay bonuses. And in order to do that, we need to be able to run scenarios. We need to be able to see how much money we have at our disposal to be able to do this. We also talked about the iron triangle, and this comes from Louise Stoney with Opportunities Exchange. She's kind of the person who coined this and developed this iron triangle concept. But being able to understand that a strong foundation for our financial model for our industry are these three components: having full enrollment, being able to collect full fee on our tuition. So not just being able to collect, from our parent pay or our subsidy pay, but even looking at that gap between sometimes what we should be charging for tuition prices and what subsidy is able to pay. So making sure that when we set our fees, that we're able to fully collect those fees, not have outstanding accounts receivables balances, but also to be able to collect that gap in those fees. And also to make sure that our revenue is covering the cost of our expenses and that true cost per child expense. And so looking at those three things, and we'll see how that comes into play a little bit further on here. So one of the things when we look at cash flow and financial forecasting is understanding that cash management is the key. And I was looking this up, and I found this description that I felt like just kind of described it pretty well, that cash flow is the lifeblood of a business, and a business needs to generate enough cash from its activities so that it can meet its expenses and have enough left over to repay investors and grow the business. While a company can fudge its earnings, its cash flow provides an idea about its real health. And so when COVID started, it was alarming at how many providers didn't really understand where their financial forecast and their cash flow was. And they had set budgets, many hadn't, but the ones that had set budgets all of a sudden realized that their budgets were set for the year, and they didn't know how long their current financial situation would get them. And I remember having a conversation with a provider, I want to say it was late March, early April. And she called and said, Virginia, I don't know how I'm going to make payroll this Friday. And it was right when we were applying for PPPs. And thankfully her PPP came in just in time, but it was a very alarming. And I think we saw so many providers doing knee-jerk reactions rather than taking a step back, really looking at how their financial picture looked, looking at their forecast, looking at their cash flow, and knowing, okay, where are we? How far can we go? What adjustments can we make? What adjustments do we need to make? And what do we need to fill in the difference? So let's just do a basic understanding of cash flow. And I know Lauren is always concerned when I hit this. topic because I get really excited about spreadsheets and numbers, and I at once upon a time thought that everyone got that excited about it, and I've learned that I'm more of an anomaly than most. And so I know that as we get into this, it can be a little bit much, a little bit overwhelming, but I hope that I've boiled it down to the basics. And we'll point this out again that, you know, this is where the SBDC shines, and it being able to provide counselors that can help you with your cash flow, with your budgeting, understanding these concepts. And so you do have resources. If this isn't a strong point for you, you have resources at your disposal to help you. People who do get excited about it. But understanding cash flow, it's really simple math. You start with your opening cash. So when you wake up the first of the month and you check your balance in your account, that's your starting balance. And then you add in all your cash that has come in, whether it's through business activity, grants, or loans, even sometimes owner infusions, money, you know, personal money that you put into your business. Then you subtract out any cash that's left your business. The primary for our industry is payroll. Right? We're always looking somewhere between 45, 50%, and sometimes as high as 80+%. Then your other expenses, any debt that you have, and what ends up at the end of the month is your remaining cash balance. So when you go to sleep at the end of the month, whatever balance is in your account, that's your remaining cash balance. And so we start out with a really simple formula, and then we beat it up with our spreadsheets and all of our transactions. And that's when I think we start to get a little bit, I think, out of sort with our numbers. So let's talk just for a second about the difference between a cash flow versus a budget, because many businesses have budgets, but not often do they understand cash flow. And I'll be honest, the entire time I was as the director at the preschool where I always had a budget, never had a cash flow, and did not truly understand the appreciation for a cash flow until COVID started. And now I worked with so many centers now on creating their cash flow, understanding their cash flow, that I think if you work it hand in hand with a budget, it really helps you to be more and more successful, especially if you get into a time where you're not sure how business is really going to continue. So when we look at just basics of a budget, usually it's a projection over a period of time, usually about a year. And we may break it down into monthly numbers, but typically we're looking at, this is what I'm expecting for my revenue for the year. This is what I'm expecting for my expenses for the year, and this is what I'm expecting my bottom line to look at like for a year. And then we typically will just divide those over 12, and those are our monthly buckets. We typically use the budget as a benchmark, and don't always, at least at one point in my life, I was told that once you set a budget, you don't change a budget. That's what it is, and then you measure your performance against it. When we start talking about cash flow takes those budget items, but more projects it as far as timing of revenue and expenses. So when you're actually expecting what month, what period of time you're expecting those transactions to occur. And then typically we advise to revisit it regularly, if not monthly. Sometimes, depending on the state of your business, you might have to do it even more frequently. There were times during COVID where we switched from monthly to weekly because that's how tight a business's cash flow was. So if you find that it's tighter, then go into a weekly projection. If it's not as tight and you're more comfortable, you can revisit it on a weekly basis. And then cash flow is adjusted according to your actuals. And so when I'm working with my clients, I say almost look at it, anything in the future is looked at kind of as a budget. And then anything in the past is looked at as actuals. And then you can adjust your projections or your budget for the future based on what has happened in the past.
I would also say if you have questions or something's not clear, just put in the chat box and we'll get to your questions, or I'll ask Virginia to clarify.
Yeah, I'm used to teaching this class with not with on a meeting type Zoom rather than a webinar. So I'm used to being able to see faces and reactions and see comments. So I'm hoping I'm not moving too fast. You will get copies of these slides. And this is being recorded. And like I said, there is support standing by.
You know, the reason why this is such an important topic right now, with the child stabilization grants that most of you are going to be having that money come in, with the workforce crisis and the need to increase wages, there's such an extreme need right now for us to really understand how to do this financial forecasting so that we're making really good decisions moving forward. And one of our concerns with the grant is that may or may not be sustainable income. So using it wisely, but you know, is really imperative right now, particularly around wages.
Thank you. All right, so some things to consider with your cash flow projections, like timing is important because you have to know when the money not exactly, but within a couple of days of when the money is coming in, when it's going out, and so that you can track how that's going to impact your cash flow. Then you're going to be projecting your loans and your grants, when you're expecting to receive those, your tuition and other revenue, and you're projecting your labor costs. And we're going to talk more about those two things because I have a degree in business, and I spent time in a couple other industries before I got started in early childhood. And really, my previous business experience, while it did give me a great foundation, I found early childhood to be an interesting situation, it was a different way of budgeting, a different way of projecting. And I don't always think that I found that some of the tools that I had already in my tool belt didn't quite prepare me for what I needed. And I always felt like I was struggling to get a handle on how to project my labor costs and my tuition, because it does fluctuate. It fluctuates with summer months and holidays, and you know, there's so many different variations that come into play there. And so we'll talk about that, and we'll show you some tools that we're going to make available to you that hopefully will help that burden. And then you're also going to estimate your expenses. And then once we've got it all into a nice little package, then we're going to start identifying where our gaps are. And we'll talk about how to look at those gaps and maybe run some different scenarios to figure out the best way to approach them. All right, so I hope you all are ready to dive into looking at some spreadsheets. I'm not going to go show you the actual spreadsheets, but I am going to show you some screenshots of this tool that we have available. And I believe Lauren has a link that she can pop into the chat box for you. The actual spreadsheet we've made available on our website, and you will need a Google account, I believe, to make a copy of it. But then once you make a copy of it, you can open it up in Excel or Google Sheets and be able to utilize that. If for some reason there's trouble downloading that, we can put another link to the actual Excel spreadsheet and make that available. So what we're looking at here is on our spreadsheet, this is actually a 12 column rows. I'm sorry, 12 columns for a full year of forecasting. It's got the month at the top. You'll see the beginning cash, this yellow 5,000. And please keep in mind, this is just a sample. These are, they're made up numbers. We've worked with several providers. And so we've taken some of their numbers, but for the most part, we're just throwing numbers in here as an example. So nothing we show you is what we think that you should be doing or where your number should be. These are just examples. But so this is saying, you know, at the beginning of November, they had $5,000 in their beginning cash. We're estimating that sometime this month, that first payment for the ARPA stabilization grant will come in. And so we have put that in the November time period. And then you can see that we're expecting the next one to come in February. And then we'll talk in a minute. Oh, I didn't mean to go that far. Okay. And you can kind of see this next column in December would be what our expected beginning balance would be after the month is said and done. So things would be getting a little bit tight if we didn't have that 19,000 coming in. And so if that, for some reason, this goes to December rather than November, we would change that, but then we might have to make some adjustments to make sure that our cash is staying in the positive for the month of December. But you'll see in this beginning upper area, you can put in if you have any other grants coming in, if there's any other loans coming in, all that would be recorded in these upper boxes under the month that you're expecting that money to come in. In the next section underneath this, we've got our cash from business activity. So this is anything that you're expecting from your center to be happening. So here we have listed the monthly tuition that is expected. We're deducting, and I should have put this in as a negative amount. I apologize on that. This should have been a negative 200 across for discounts. And then if you had any, you know, see here, we're expecting maybe 500 to come in from registrations in December. Usually the beginning of the year is a productive time in taking registrations for the next school year. So that would be listed there. And then at the bottom, you see you have a total cash from business activity of $12,075. That gets added to your total cash and loans. So you have total cash in of 36,000. And so all we're doing is taking that beginning balance, adding in any cash or loans, adding in the revenue from business activity to get your total cash in or your total revenue. All right. So then we jump down to the next section of the spreadsheet and we're looking at expenses. And like we said, huge percentage comes out from your payroll. And based on our calculator, we've done this on, November happens to be a 5-week pay period. So payroll as a percentage of revenue is really high in November. It's not as high in the subsequent months because those are 4-week months. And that's something new that we've added to this calculator to be able to help you kind of gauge and keep track of what you're estimating your percentage of revenue is as for your payroll as a percentage of revenue. But you can see here, you've got your payroll, total payroll costs for the month, your payroll service fee, so whatever you pay for your payroll company, an estimation in the employer taxes. If you have any benefits, you would add in your workman's comp insurance here, and then it would give you a total of your total payroll cost. And then it figures out that percentage for you. And then in the bottom of this section, you have all your other expenses. So your rent, any repairs. I've condensed this just so I could fit it onto this screen for you and it not be a complete eye chart. And you can see, here's where we're talking, your internet, your telephone, your rent, your utilities, often those can be spread. They're usually pretty consistent. But like your insurance, depending on how you pay your insurance, that may be a bulk sum whenever your insurance policy comes up. So for some centers, it's a monthly, for others, it's just a yearly. Repairs and maintenance can fluctuate. So maybe you've got, you're planning on some mulch in February. You would record that in an actual time that you're expecting to record or to spend that money. Maybe you're planning to upgrade your website, or you have your yearly fees they only come out in December. That's another area I highlighted to show that that's not something that was evenly distributed across the months. And then at the bottom of this section, you have total expenses, as well as, so total expenses takes your total payroll, your total other expenses, and gives you your total expenses. I added this for net revenue. So this just looks at your revenue coming in for the month minus your expenses for the month. And that's just to gauge, that's what your P&L report, if you use QuickBooks, that would be what you would expect to see on that report there. But then for actual cash flow, this is taking your total cash in that we had from that previous report minus your total expenses would give you your cash flow subtotal. And then there's one other section underneath this and I'll show it to you right here. Right underneath this, you'll see any debt. So if you have credit card debt that you're paying off, that's not included in those other expenses. If maybe you took out an idle loan and that's going to need to be repaid, or if for some reason your PPP didn't have complete forgiveness, you would have loan repayments there, or any liabilities that you have outstanding. We've seen church loans that need to be repaid. That would all be under here for your final ending cash balance for the month. And so what I did here is I cut out this whole middle section. So I'm just showing you the beginning cash, the cash in, so you can kind of see where we're starting. Then I've dropped all the way down to the bottom of the report. So you can see in November, we started with 5,000 cash. We had our cash and loans, our revenue. Then we had our expenses that we subtracted out. And then we have our ending cash at the very bottom. And then that carries up to the top. So the next month we started all over again. We go through the whole process each month. And then at the bottom of the month, we have our ending cash. And now just to make this something to give us something to talk about, you can see December and January, we actually had an uptick in our beginning cash. So, as a business, we want to see that our business is growing in its available cash. But then all of a sudden here in February, we have these parentheses. And when we started working on these in COVID, we called these parentheses pitfalls. These were the holes that we were about to step into. And we pointed these out that when you're working with a 12-month cash flow, this gave you time to see where those pitfalls were going to be. So this gives you from November to February to go, oh no, there's a pitfall, there's a hole, there's a gap in our cash. Where's it coming from and how can we fix it? So we said, beware of the parentheses. And you'll see that those parentheses start at the end of January. Well, what you don't see is that I buried a huge expense, a $20,000 expense. It could have been an error that, you know, I put in 20,000 rather than 2,000 and I fix it and then we're okay again. But maybe there's a planned expense for 15,000 that maybe we have to say, we might have to change that up. We may have to figure out what else we're going to do because that's going to put us in a negative situation. Maybe we have to look at scaling some things back, or, you know, if this were to continue on into the rest of the year, we would need to look and see what is happening. Why is that happening? And so if there's something other than, if you're starting to see these numbers trail down or trend down, that's alarming. If they're holding steady, you know, for right now, that could be a good thing. If they're going up, that could be a good thing as well. But we want to be looking at reasons that we're either hitting the parentheses or we're starting to trend downward. So when we see those pitfalls, when we see those trends that we don't like, we want to see what's happening. And so I've highlighted, this is your cash flow deficit and the things that can contribute to your cash flow deficits. So we have enrollment and tuition. So if you're not fully enrolled, that's somewhere where can you fully enroll? Some centers can't fully enroll right now because they can't find the staff to be able to open up some of those classrooms that they closed during the quarantine period. And so you might want to look at, what can I bring in more students? Because more students can often increase our cash flow. We can look at our tuition. Can I make changes to my tuition? We've talked to providers who are raising their prices up to 2 times a year, and they're communicating that with their families, that this is what you can expect as we're incurring more costs. Our payroll's going up, minimum wages going up. We may have to make adjustments. And, you know, a good rule of thumb is your parents should be expecting a tuition increase at least yearly. If you're communicating that well ahead of time, letting them know what to expect, prices, just about everything is increasing. Why shouldn't your tuition be increasing as well? Your payroll can also have an effect on your deficit. Looking at, you know, minimum wage is contributing to that. But sometimes, I don't think this is the situation right now, but sometimes we can be carrying more people than we need. Right now, I don't think that's a possibility, but it is something to consider. But looking at, as we're looking at raising our payroll and the pay rates, sometimes you may want to run a scenario of where you want your pay rates to be, to see what kind of a deficit it creates, so that you know what you have to do with your enrollment and your tuition to make that happen. Because sometimes we just don't know what's going to be needed, and we just say, I can't pay anymore, and that's the way it is. But in running these scenarios, we can say, well, maybe I can. Let's find out. Let's see what we need to do. And then also looking at other expenses. Are there things that we can do to reduce some of those other expenses to be able to increase what we have available for payroll? And then also looking at, one of the things I don't have on this is the ARPA stabilization and other grants. As those are coming in, that can help offset the gap. But like Lauren said, that's not going to be a consistent cash flow. And so we could use that to infuse our business and to get those bonuses and wages up. But then we need to come up with a plan on how we're going to continue that moving forward. Are there any questions so far out there, Lauren?
Nope.
I've either lost everyone or or we're tracking. I hope this is valuable. Oh, and someone just said they celebrate spreadsheets with me. So thank you for that. That fuels my energy. All right. So again, the snapshots that we showed you for the cash flow, that whole glorious thing is available on our website for you to play with. Something that I just put together today, because I know not everybody is into spreadsheets, and often just opening a spreadsheet or the thought of opening a spreadsheet can send you into shutdown mode. But I wanted to give you a way to be able to run some scenarios and be able to come up with a way to compare what your tuition, your enrollment, and your payroll look like. So these are extra tabs that I've added to the spreadsheet. And one's called payroll scenarios, the other's called tuition scenarios. So on here, rather than having 12 months, and you can do this, by all means, you can do this for 12 months. It's available on the spreadsheet and it will roll into the cash flow. But if you just want to look at different scenarios, so let's say you list, and again, these are just sample information. We're not saying this is what your pay rate should or should not be. This is just examples. But if you list out, and we did this all based on hourly rates just to keep it simple, you can list out your staff, scenario 1 pay rate, which would probably be your current pay rate, and then 2 different scenarios of what it could be. You could, maybe scenario 2 is what your ultimate goal is, and maybe scenario 3 is a stepping stone. And you would plug in the number of hours. You can also utilize this to say, hey, I want to add a new staff person. And this new staff person would come in at this pay rate for this many hours. What's it going to do to my overall payroll budget? And this will tell you what the percent of increase is. Down at the bottom, it will tell you really what your average or your total payroll percent increase would be on the 2 different scenarios. And then you can add in your estimated payroll taxes, benefits, and other to get a total payroll cost and what your percent of difference would be. And so, you know, couple scenarios, if you want to see what minimum wage increase is going to look like in January, this would be your current, and then you could do your in January and see what the scenario would make a change for you. And then up here, so this is based on number of pay periods. So, and I've now realized pay period is not all one word. But, you know, if maybe you decide that a more accurate estimation for you would be 4.3 for the month, you could do that. Or if you want to do this based on, you want to see what this looks like for every 2 weeks, you could just change this number to 2, and then it would change it out for just 2 pay periods. So you can see here, this from scenario 1 to scenario 2, we've increased everyone, it looks like $2 an hour. The overall increase would be 16.6%. So somewhere, either our other expenses would need to come down, or our tuition would need to increase by 16.6% to cover this scenario. And so let's take a look at the, I went through this fast. So here's your tuition scenarios. You can list out all your tuitions or your classrooms. So if you had a 3-day rate and a 5-day rate, or a half-day rate and a full-day rate, you would have to list each one of those here and the different tuition price. But this, if you're a full day, 5-day school, and you list out your capacity, it would give you your total capacity. And then it would also give you your percentage of capacity across the top, or your total enrollment with a percentage of capacity. So for this instance, we have infants, we have a capacity of 10. Here's your 3 different rates. So 200, 220, 225. I've done that for each of these sample classrooms. Based on enrollment, I used almost the same enrollment for each scenario, but maybe you're considering opening up a class, and you want to see, right now it would be a 0 in your scenario 1, but maybe you're opening up another classroom of 10, you would add in 10 here, and then you can compare scenario 1 and scenario 2, because it gives you the calculation based on, right here is the number of tuition payments for the month. So it would be just comparing like numbers, 4 weeks and 4 weeks. And then it'll give you your percent of increase. So your overall tuition. So even these 2 scenarios that I've run here wouldn't even get close to what we had projected for needing for payroll. But that's just for comparison. But you just type in your tuition, what you're estimating would be the change, and then it'll give you the change per classroom, and then your total, what your total impact would be for the month, or for the number of weeks that you've budgeted there. And
So
then if,
I think it's important that the students understand what cells to change and what not to change. Can you just briefly explain that?
Yeah, and I think what I'm going to do for these 2 scenarios, I'm going to flip over to the actual spreadsheet so that I can show this, because this was really my last slide, and I wanted to open up for questions or whatever we needed to do at this point.
Mm-hmm.
Oh, there it is. Okay. Okay, so here is, let me pull this. Oh. Okay, so here is the tuition scenario. So the only thing here that you would need to worry about changing is anything in gray. So if you wanted to change this to a weekly, you could just change this to 1, and you see the numbers change. I did it just based on 4 weeks, because most months have 4 weeks worth of tuition that come in. But if you wanted to do it 4.3, you could easily do that across the top here. So you could change infants. Let's say your infant, or let's say your pre-K, you had a total of capacity of 4 because you had closed down some rooms. So right now you're at 18. But let's say you open up that classroom and you can start, you're expecting that you could take 35. So now we're just changing anything in the gray here. And so now you can see for that classroom, adding a second classroom and increasing your enrollment, you've now, scenario one, you've increased from 12,700 to 25,500. Or if we want to keep everything consistent and just look at changing tuition prices, you know, we have current tuition rate of 165. Let's say we want to see, okay, I want to see what this looks like at 175 and 185. Same enrollment, so that we're looking at like numbers and you can see the change. There's a 6.1% change there and a 12.1% change there. Just changing anything here in the gray. So you've got your rate 1, rate 2, rate 3, and then each of your scenarios for enrollment. So let's say I want to open up a new pre-K class and I can bring in 15 more students. It's going to be the same tuition rates. Let's see, 165, 165. So let's say up here, we're not looking at changes in tuition, we're just looking at changes in enrollment. So this first scenario, I don't have any because I've just got this 18 of the existing classroom, but I've just opened up 15 more spots and I think I can fill 10 of them. I'm just going to put 1 in there so that it gives me, I'll fix that. So now you can see that just adding that new classroom, not changing rates, is going to bring in a little under 7,000 extra in revenue. That particular classroom, obviously you've gone from almost nothing, so that's a little bit, but if you come up here, you can see you've just increased by opening up those 10 spots, almost 15%. And then over here with the payroll scenario, this really here is where you're putting in your pay rates. So you can change all the numbers in here. Anything gray you would change. So here's this is if you wanted to put in a new staff member and maybe you're going to bring them in at 11. And they're coming in scenario 1, you don't have them. I'm going to have to rework that one as well. But maybe you're in scenario 2, you're now bringing that person on at 40 hours a week. You've just increased your payroll expense by $1,700 a month. And so that gives you a way of seeing what the change is. And so really you can use this over and over for all sorts of different scenarios, it helps you to see, you know, the difference maybe in your summer program versus your fall or regular school year program, if you have that. Difference in pay rates, difference in adding new staff, or whatever you need to do there. Anything else you want to see, Lauren? Or anybody else want to see?
I think we just want to know if anyone has further questions or something they want you to review again. So we've kind of given an example of a spreadsheet. I think in our industry, it's just really important that whatever tool you use, typically it's a spreadsheet, but you use something that you understand how to use so that you can run these payroll and tuition scenarios, because in our industry, I think we just have to have that capability. So we've provided the spreadsheet, and what I would say is, if you're like, whoa, that's too much for me to understand, then let us know, and either we can go over it with you or we can connect you with your SBDC, because that is a statewide network that is just ready to support small businesses.
Yeah,
Well-
and I think, you know, what went into these calculators was really, that was one of the things as a director I always struggled with, was knowing, based on all of our crazy hours and variations, and how do I budget, and then how do I know if I do these increases, how is it going to impact my budget, and how does my payroll relate to my tuition?
And, you know, we've been just, I think we shared in one of the last workshops that we've been attending some pretty great business conferences around, you know, really focus on early childhood business model. And what we've been hearing, and I think we all understand, that to compete for really high quality workers, we have to get our lowest paid employee up, even past the minimum wage. The number we're hearing is about $15 an hour, and that may be a stretch, but you have to have confidence in your decision making, that if you increase wages, it's sustainable. And so it can answer a lot of questions about these tuition increases or other revenue streams that you have to be able to pay that much to everybody.
Well, yeah, and one of the most dangerous things that I heard when we were getting ready for the first round of minimum wage increases, on some of the online or Facebook forums, I was seeing directors asking each other, well, what percentage are you raising your tuition rates to accommodate for your payroll increase? And I was like, whoa, time out. Don't get a consensus from your peers on how to adjust your tuition prices, because you have to look at your center, your tuition rates, your payroll rates, and make that decision based on your budget. It's got to be an individual thing. You know, if you raise your tuition based on what somebody in a neighboring city does, you could be not raising your rates enough, or you could be pricing yourself out of what your current market and your families can withstand. So you have to take all of those things into consideration.
So we do have a couple of questions. Crystal's raised her hand, so I'm going to go ahead and try and allow her to talk. But in the meantime, I'm going to ask a couple of, well, Lauren, you answered it in the chat, but see if Crystal wants to unmute her mic. But Pam asked, can you recommend what percentage of salary should be the total of your budget?
Good morning. Can anybody hear me?
Yes,
Yes.
Crystal, we can.
Okay, great. So that was a question for Kim. Did you say somebody you were gonna, or me first?
Nope, you can go ahead and ask your question.
Okay, so we were doing a couple of things, and actually at the early stages thinking about childcare. So we registered for this to kind of learn more, and we are just getting inspired of how the same information can be used in other industries. So my question was, with the cash flows and the spreadsheet and the budgeting, is there a way to dig deeper? Like, how do I, because when I reached out to SBDC, they were encouraging me to do webinars, but I need to work with somebody to kind of think about these numbers differently and crunch them and really find out if this is going to be a viable option for us to go into as a new business. and to get into this. So how do I reach out to somebody and actually get somebody? You guys keep talking about there's one-on-one help. And when I reached out to my local SBDC, they directed me to webinars and such. So how do I get a one-on-one person through the SBDC to kind of ask questions and dig deeper into what I'm building?
Crystal, I'll take that one. I've got your name from the webinar, and I will reach out directly to you and work with your SBDC to get you some one-on-one counseling. We do encourage people as they are starting out to get some basic education, which by coming to the webinar you have.
Yes.
So we'll now get you connected directly with a center to do some one-on-one counseling.
Wonderful, thank you.
Okay. Were there any other questions that one person asked about the payroll sheets, and those were available in the chat? Lauren had put a link to the tools, so you can get that directly from their website.
And then somebody asked about payroll percentages, like, you know, what is kind of the industry average? And I put a range in there. I think that's a really good question. And that's part of that confidence, like we call that data-driven decisions, where you know typically where your percentage is. The industry averages are between 50 to 70%. Faith-based programs tend to have that higher percentage. Typically they might pay a little bit more or have lower overhead costs. Maybe they have a reduced rent or no rent. Our for-profit businesses tend to be around 55 to 60%. And you know, so that gives you an idea.
Okay. It looked like we have one more hand raised. I think if you all have a couple of minutes, I can go ahead and unmute Callie and let her ask her question as well. But I think Callie jumped off before I got to answer her question. Okay, I'm going to go ahead, and if anybody has any additional questions, type them in the question window, but I'll go ahead and close out. You'll receive an email with a link to the recording from today's session and an evaluation into the slides. If you'd like to sign up for upcoming webinars or to access the recorded webinars, you can visit the virginiasbdc.org training site. Our previous webinars are loaded under videos on our website. Be sure to check out our next session, which is on marketing, which is next Thursday, November 11th. So, and I do see we had a question in the chat about last week's recording. Those are all listed on the Virginia SBDC website. So I thank everyone for attending today, and hopefully we'll see you again on next Thursday. Thank you, ladies. You did a great job again. Thank you.
Thank you.
Thanks.